crisis and and the financial crisis, that was the heart of the global financial crisis, and it was global in that sense. This really was a natural disaster that hit an economy that was doing well, with a banking system that was well capitalized and highly liquid and understood its risks pretty well, and has actually been a source of strength. So that's very different. Although we have seen lines emerge in the broader financial system, in the capital markets, for example, under great stress. We've seen something, and no doubt we'll come back and look at those when it's time to do that. I mean, what happened here was essentially people around the world, sometimes required by their government, sometimes on their own, withdrew from certain kinds of economic activity to protect themselves from the pandemic all around the world. There's no precedent for that. There's no playbook for that. So our response was actually quite different from what it was in the financial crisis. So we immediately cut rates to zero. We raised our asset purchases essentially without limit to support market function. We weren't trying to stimulate the economy in the sense that the economy was partially shut down. The idea was not to stimulate people to go out to spend. It was to provide a little bit of comfort, to assure that credit was flowing to households and businesses, and then when the expansion came, to support that recovery and expansion with monetary policy. So very, very different. Also, this business of lending to non-financial corporates and also to state and local governments, unique. And that was because the intermediation process simply stopped. The financial system, there was such a flight to safety when the pandemic really hit that credit intermediation between savers and borrowers just essentially stopped. And we had to step in as a backstop for the municipal market, for the corporate markets, and have been doing so for smaller businesses. And we did so around the world for dollar funding markets. Now, that was similar to during the financial crisis. So it's very different. But I would say this, though. So we had the deepest quarter loss in GDP that we've ever had. But remember, the economy was strong back in February. So there's a lot of strength in the economy. The recovery in May and June came sooner and was stronger than expected. So there's still a healthy economy under here, except for this area that's been directly affected by COVID. So if we can keep the disease under control, the rest of the economy can recover fairly quickly. The problem this time is that there's a particular part of the economy which involves getting people together and feeding them, flying them around the country, having them sleep in hotels, entertaining them. That part of the economy will find it very difficult to recover. That's a lot of workers. That's millions of people whose jobs they're really going to struggle to find work. And we need to stay with those people. We need to support them and help them get back into their working lives, stay in their homes. Congress has done a lot on that. We've done a lot, and we'll keep doing what we can. But I do think it's that's going to be the issue. I think we will get through this period, maybe with some starts and stops, with reasonable growth. But ultimately, we're looking at a long tail of probably a couple of years at least of people of relatively high employment, as people who worked in those industries will struggle to find work. And again, we need to support them.
Yeah, so kind of very different trajectory as you've described.
Right.
So in that context, do you see any role for the Fed in terms of those financial institutions that really do community development?
We're very highly engaged with the CDFIs, the Community Development Financial Institutions, and those of them that are banks, are taking part in our programs now. They took part in the PPP liquidity facility, so we strongly support them, engage with them, and the same is true of MDIs. I think that isn't where the liquidity shortage is. That isn't where the big problems in the economy are really in the service sector and the manufacturing sector. It's in the real economy this time. The last crisis was really around the financial system and big credit losses. Here we've got highly capitalized institutions, and we have credit problems in the real economy, and we have we have a different situation this time.
Thank you. So we are almost out of time, unfortunately, and I thought what I would do for just our last minute or two was to cycle back to the review, this very public review of the monetary policy framework, and ask if you had any additional thoughts or perhaps the next steps that you expect the Fed to take in terms of moving forward with the changes that you've described for us.
Well, first of all, I'm very pleased with how this worked out. Again, I think it's productive both from the standpoint of just public engagement, and that's always a good thing for an institution like the Fed, particularly the Fed, which has this precious degree of independence. And I think that puts a burden on us to seek accountability, not just go through the motions, but really actively engage and explain ourselves as clearly as possible to the public and the public's elected representatives. So I think the review has helped on that. I think in that sense, it's been a success. I think really the changes to our framework, time is going to tell. And what we do going forward is really going to decide the effectiveness of the changes we've made. I'm a set of changes to deal with what is a reality of a quite difficult macroeconomic context of low interest rates, low inflation, relatively low productivity, slow growth, and those kinds of things, and a flat Phillips curve. You have to put all that together and see that we've really got to work to find every scrap of leverage in helping stabilize the economy, which is our role. So time will tell, and our actions ultimately tell. But I'm very pleased with you and so grateful to be part of such a great organization where we've really used every part of the organization to advance this project, and I'm really proud to be part of this.
Thank you very much, Chair Powell. It was really a pleasure both to speak with you this morning here, but also I'd like to congratulate you and the Federal Reserve team, a thoughtful and publicly engaged review of the monetary policy strategy. So thank you very much.
Thank you very much, Susan. Good to see you.
Good to see you as well. And now we'll shift to the second session in today's agenda, which will focus on the trend decline in growth. And the paper for this session will be presented by the author, Ufik Akajit, from the University of Chicago.
So thank you very much for this kind introduction. Today, I'll be talking about the productivity slowdown and the declining business dynamism in the US and around the world. And this is joint work with Sinatesh from Federal Reserve Board. As all participants are familiar with, there has been a productivity slowdown in the US over the past several decades, and it is important to understand the underlying mechanism in order to come up with the right policy recommendations. So what we try to do in this background paper, is to put together several other trends at the micro level that can shed light on the macro productivity. Technology, that firm will grow very rapidly and it will steal jobs from other unproductive firms. And on the flip side, this unproductive firm will be shrinking. So as a result, the dispersion in the growth rate distribution of firms tells us that it's a dynamic economy with a lot of experimentation. Unfortunately, in the data, we observe that the growth rate distribution has been shrinking over time, which means that there is less experimentation with new technologies. And as a result, after these micro observations at the macro level, we observe productivity growth slow down. And we also see a decline in real interest rate during that time. So are all these empirical facts related? To answer this question, we built a general equilibrium theory that represents the US economy, and we try to ask if all these facts can be rationalized simultaneously in a macroeconomic framework. And the advantage of this is that once you have this macroeconomic framework, you can do a potential horse race between alternative scenarios. And you can ask what might have led to all these observed trends in the data. And indeed, we try to entertain several alternative hypotheses. For instance, a lower effective corporate tax rate during that time for incumbents. Second, a higher R&D subsidy to incumbents during that period, or an increase in entry barriers. Another potential explanation that we implemented is that maybe due to some other reasons, there have been a decline in interest rate, maybe due to discount rate of the household. Another potential explanation was ideas becoming harder, so as a result, the innovativeness of the firms are declining. And another hypothesis that we entertained was weaker union power during that time. Unfortunately, none of these mechanisms could speak to all these 11 facts simultaneously, except one fact. And that fact is the lower knowledge diffusion, meaning that when a market leader comes up with new technologies, we see less and less diffusion of this technology to market followers. Because it's not only important to come up with new technologies, but diffusing these technologies is also important to make the entire economy more productive. Unfortunately, we see this knowledge diffusion declining over time. And this can also be interpreted as even if the market followers are learning about these technologies, they are not able to implement these technologies due to various reasons. And the question is, why is knowledge diffusion declining over time? So in order to answer this question, I'm going to go back to the data, and I'm going to look at some other new trends that we see. For instance, when we look at patenting of the firms, the patenting by the largest 1% of the firms have been increasing tremendously. Around 1980s, 35% of the patents were produced by the largest 1% of the firms. Today, this number went up to 50%. When we look at the share of inventors working for young firms, around year 2000, this number was about 15%. Now, less than 8% of the inventors are working for young startups. And that decline could be a productive reallocation, or it could be varying. In order to answer this question, whether this is productive or not, let me show you two additional facts. The fact on the left is showing that when an inventor moves from a small firm to a large incumbent, the innovativeness of this inventor is declining. They are producing less patents and they are influential patents. However, when with compensation of this inventor, meaning the salary of this inventor, the salary is increasing after the move from small firm to large incumbent. This means that the private compensation of the inventor is going up, but socially, this inventor is producing less important patents for the society. So as a result, this move from a small firm to large firm, or this reallocation, is something that we should keep an eye on in terms of the well-being of the society. So let me summarize these additional facts that are hinting at why there might be lower knowledge diffusion from incumbents, from market leaders to followers. First, more and more patents are produced by the top 1%, and more patents are being reassigned or sold to top 1% of the firms. And most of the time, these patents are used as sleeping patents, and they are not being used. They are not being implemented. They are just being bought for strategic reasons by the market leaders. Another important fact is that market concentration and the share of litigated patents are positively associated with market concentration. So as a result, we need to keep an eye on this increase in concentration of patenting. On the inventor side, we see that lower share of inventors are working for young startups. And we also see that when an inventor is moving from small firm to a large firm, the salary of the inventor is going up, but they are becoming less productive in large firms. Startups that are founded by new inventors are generating more employment on average. But unfortunately, we see that startups that are being founded by inventors are also declining over time. And as a result, there's a lower entrepreneurship by inventors since 2000. And in addition, M&A activities have been increasing, but M&A activities are negatively associated with business dynamism at the sector level. And finally, the lobbying activities by the largest incumbents have been increasing dramatically during that time, which is also something that I think we should keep an eye on in terms of understanding why market leaders are dominating the market and why is there lower knowledge diffusion from leaders to followers. So, of course, these stories that I mentioned up until now was related to the US, but we also see a similar trend in some other countries. For instance, for Italy, we did an interesting exercise, and we saw that indeed, when firms are gaining some additional market, and as they are becoming the dominant market leader, their innovativeness is decreasing, but they are getting more connected to the political system by hiring more politicians. So hiring local politicians is allowed because being a local politician is a part-time job, so they can work for a company. So what we see in the data is that market leaders are the ones that are hiring most of the politicians, local politicians. And in addition, they are producing less patents relative to their size. So this is also telling us that there is some strategic behavior by market leaders as they are becoming the market leader. We also did some analyses for the developing economies in order to understand why business dynamism might be going down in developing economies. And of course, there is not a one-size-fits-all recommendation for all countries, especially in developing economies, the concerns are different. In the case of Turkey, for instance, firms are smaller and they are more sensitive to the availability of credit. And in the case of Turkey, we see that there's a decline in business dynamism in Turkey since 2013, but this is mostly due to the fact that there is relatively less available credit for market followers. Market leaders access to foreign markets, but market followers are not able to access foreign markets. So as a result, the lack of credit is slowing down competition, and as a result, rivals are not able to keep up with market leaders, and the business dynamism is declining. So in order to, so let me just conclude at this point. So what we try to do in this background study is try to understand the underlying reasons for the productivity slowdown in the US and various other countries. In the case of US, we found that knowledge diffusion or the implementation of new technologies by market followers have been declining over time. And the data shows that there's a massive concentration of ideas and inventors in mature firms, and these ideas and inventors are potentially being used for strategic reasons. And in order to prevent followers from using those ideas or producing new ideas, as a result, competition is declining and productivity growth is slowing down. So what are the policy implications of these findings? Clearly, we need to intensify the competition at the frontier. Market leaders should be challenged. So one thing we can do is we should reconsider the policies that are favoring market leaders. For instance, the R&D tax credit is something that is being utilized mostly by market leaders because you need to have an army of lawyers in order to utilize these policies. And the followers are not utilizing these type of policies, and this might be preventing effective competition at the frontier. Second, enforcement of antitrust policies is crucial. This is going to ensure that the competition at the top is not being affected by the massive concentration and strategic use of patents by market leaders. Another important policy recommendation we think is that the advertisement or making the secondary market for technologies more effectively utilized will let the knowledge diffuse more and technologies diffuse more in the society. And then finally, when the local competition is declining in the US, relying on foreign competition is an important way to proceed. So these days, we are talking also about whether the borders should be closed to foreign competition and foreign products. Indeed, foreign competition are keeping the US market leaders on their toes, and removing foreign competition would also be a detrimental move that will reduce the business dynamism and competition in the United States. Thank you very much.
Thank you very much, Ufuk. The discussant for this session will be Brown University professor Gauti Eggertsen. But before I turn the virtual podium over to him, I would like to just briefly outline the process that we'll use for the general discussion. So about halfway into the discussion remarks, you'll see, those of you who are participating in the conference will see a phone number. If you would like to make a question, to ask a question, please call that phone number, and we will queue up as many of those as possible. And I'll ask you to help me to get in as many as possible by keeping your questions very succinct. And with that, let me turn things over to Professor Eggertsen.
Well, thank you for that introduction, and thank you for inviting me here. So the title of this session is Why Has the Trend Rate of Growth Declined? And I guess the answer being offered to us by the author here is right in the title of their paper, Slowing Business Dynamics. So if I just try to summarize the main message I take, or I think you should take out of this paper and related work, is that over the last 40 years or so, we have seen a market increase in firm concentration and monopoly power. In other words, more and more of the sales in any given industry is being done by fewer and fewer firms. And this is a development widely documented, not just in this paper, but in closely related work. Now, so the idea in this paper is then to tie this development to slow down in the trend growth of the economy, or productivity growth. So what is the trigger here? So the thinking is that this has led, or associated with this has been a reduction in business entry, in innovation, and in overall dynamism in the economy. Now, so what's the channel the authors are here focusing on? So the main driving force here is in what the authors call knowledge diffusion. Okay, so there has been a decline, according to the authors, in knowledge diffusion. So what is a decline in knowledge diffusion? So let me frame it in the terms the author do, although I'm not going to try to write out their model here in the 10 minutes I have been given. So here you see in the red dot, this is a leader in a given industry. Okay, in the blue dot would be the follower in that industry. Now, in the model that the authors construct, there is a probability, a delta in each and every period, that the follower catches up to the leader and manages to produce with the same cost structure, right? And the idea, and how does the follower catch up? Well, by accumulating the knowledge and know-how in how to produce at the same level as the leader in that industry. So the idea here is that this diffusion of knowledge has declined over time. Okay, a reduction in this delta. Okay, and now this reduction in delta, the author show, leads to an increase in concentration and in markups in the prices the firm charge relative to their marginal cost, which in turn trigger a reduction in experimentation by the leader, and a reduction in the entry of newcomers, that is, of firms entering the industry. In other words, the leader has taken off far enough so that there's little hope for those behind to catch up. Now, so what is the evidence the author provide for a reduction in knowledge diffusion? The evidence they mostly focus on is patent production, or the nature of patents. And they show rather striking evidence that if you take the top 1% firms, the top 1%, and now it's not income, it's the firms, they're accumulating more and more. And then they show a correlation between the accumulation of patents This trigger is in turn correlated to more litigation, and this in turn is correlated to higher markups. So this is one interesting feature. Another interesting feature of the data they document is that there's a decline in the share of patents issued by new firms. Finally, they dig into the nature of patents, and the nature of this pattern seems to be changing a little bit over time. In particular, the patents seem to be less sort of broad-based, big idea, and more minute, which they then approximate with long duration of these patents. So the patents is concerned with little incremental things, and citing, and one measure of that is that they cite themselves a lot in the patent. And so the argument is that these patents seem to more be to try to prevent competitors to catching up rather than developing new ideas. And finally, there's an interesting data there that suggests that are more and more hiring up the talent, hiring up the inventors. Not only that, not only are they hiring up the inventors, when the inventor shows up, even if he's actually getting higher wages, they seem to stop inventing. In other words, their productivity declines. So the overall picture that seemed to emerge here is one of sort of big, lazy, fat firms charging high markups and not doing a whole lot with it in terms of innovation. And this is then suppressing growth and overall dynamism in the economy. So it's a rather, it's an outlook not, let's say, favorable to the big firms and the economy. Now, so if I just sort of move back to the big picture, which I hope to leave you with, is that, which I think is relatively robust, because it is corroborated by a big number of studies, and this full paper is sort of digging in on, is that does seem to be a rise in the market power in the US, and that's consistent with a large complementary literature. And it turns out that this, coupled with a reduction in real interest rate that we're going to hear more about today, you really needed to help rationalize a large number of phenomena we see in the macroeconomy. Which otherwise would seem puzzling. For example, it's very difficult to rationalize why investment has not increased at the same time as the interest rates are at historic lows. Similarly, it's hard to understand why wealth to output measured in the value of the stock market and all marketable wealth has increased a lot, while the capital stocks seem to be stagnant, without resorting to there is an increase in market power. And this is just suggesting that, or reminds us that just that because the stock market goes up, that does not necessarily need to be good for overall growth, because it could be reflecting just an increase in rents, in markups that are not necessarily contributing to overall welfare. So I think this paper is speaking to this general question. But remember, now what was the original question? Why has trend rate of growth declined? In a way, and I don't want to diminish what the paper is doing, in some respect it's just pushing back that question to why has the transmission of knowledge slowed? Okay? And one aspect here is that I don't think the paper is pushing too far yet, although it's pointing us perhaps in where we should be looking to for the answer of that question is why has the transmission of knowledge slowed? Now, one hint the authors give us in this paper is perhaps there's a reduction in antitrust enforcement. And here I'm a little bit skeptical, and one of the reasons I'm a little bit skeptical is that while it's true that antitrust enforcement has declined since the 1970s, the markup seems to have followed a U shape. So you would need then the argument that, they were gradually increasing antitrust movement until it peaked in the 80s and then declined. And I think it's more difficult to formulate that argument. Also, I'd be curious if you could make that sort of U-shape argument for the patents in the data, because the authors are only discussing 1980 to current date. So the question is, before that, can you explain those? And there I'm a little bit more skeptical, although I think that is to be seen. Now, but what could be the candidate? Remember, we're looking for something U-shaped or, inverse U, a hump. Is there something like that in the data? And here I just have a couple of suspicions. of suspects. So one of the things that has been very fruitful in trying to understand the fall in the real interest rates is demographics. So one question is, can we try to link demographics to also the fall in dynamism and the rise in markups? And I suspect the answer there might be yes. So let me first just remind you of, so we were looking for a more unifying explanation that explained the fall in interest rate and simultaneously perhaps the rise in markups. So one of the things that we've seen now in the recent years is that the population is moving below replacement rate. In other words, in future year, we should start expecting the world population to start shrinking. Okay, and demographers have told us that that time at which that's going to happen is already happening in the industrialized world, but that time at which that may happen in the world is actually closer than we think. So this is a figure from Chad Jones just showing the fertility rates and how they're declining across the world. And as you can see in the title of his paper, he is suggesting that perhaps this may mean the end of economic growth. But this is not a hump shape. If you want a hump shape, though, take a look at the evolution of the labor force in the blue line in the US over this time period, and in particular, the civilian labor force, which includes the increase in participation of women. And you see that it peaks in 1980 and then it goes down. So maybe there's a hint there that demographics may be playing a role. The mechanism could be that, when you have more and more older people, they're less willing to adopt new products. That could be and reduce the incentive to innovate. And similarly, there can be a supply effect to the extent that the age composition of the workforce has an effect on innovation. That could similarly play a role. And I think there's a literature now emerging that explores these questions. But I'm out of time, so let me just conclude. There is increasing evidence of higher concentration and falling dynamism in US industries. Now, while that's good for the stock market, this may reduce growth and innovation, and the paper here provides an interesting mechanism for that. And the ultimate question, though, is what is the potential source for this development? Is it antitrust, or might it even be demographics? That's an open question I don't think we have an answer to yet. Thank you.
Thank you very much. There are many interesting and important issues on the table, and we do have a number of people who would like to ask a question. And so in a moment, we will go in this order. First, Jose de Gregorio, second, Laura Velkamp, third, James Viterba, Ignacio Visco, and fifth, Chad Syverson. However, let me, while we're setting up, let me take the prerogative of the moderator to ask the first question. And this work, I think, really convincingly highlights the key role of knowledge diffusion in helping us to understand the decline in business dynamism and slower growth. I'd like to hear more about what the impact of lower interest rates is in that context, in particular to the extent that market leaders are able to respond more aggressively. That could actually change, perhaps exacerbate some of the dynamics that are discussed in the paper. So now let us go first to Jose de Gregorio to ask his question. Jose, can you hear me? Jose de Gregorio? Jose? Okay. Okay, so perhaps I'll come. Jose, me? Please. Yes, we can hear you. Please ask your question.
Yes, I'm here. Hello?
Yes, we can hear you. Yes, please ask your question.
Can you hear me?
Jose? Yes, Jose.
Hello?
Jose, please ask your question. Okay, then next to Laura Velkamp to ask a question. Laura, can you hear me?
Hey, so markups and profits are usually seen as evidence of, but they can also be seen as compensation for risk, as we'll hear more about the last 12 years.
Thank you very much.
Markets and yes, I can hear you. Can you hear me?
Yes, we can hear you, please.
Okay. Markets and profits are usually seen as evidence of market power, but they can also be compensation for risk. As we'll hear more about, the last 12 years have been an environment with very high perceived risk. And so starting a business or a new product line, I'll want compensation for this risk in profits. And that risk might deter productive new investments and decrease measured productivity. It might also not deter unproductive incumbents, leading to dispersion. So what facts lead us to believe that high returns reflect technology diffusion and not risk? Or are these complementary theories? Thank you.
Great. Thank you very much. Next, we will go to James Paterba. Jim? Jim, can you hear me?
Yes, I can. Yes, thank you, Susan. Ufuk, I wanted to pursue the very interesting fact you report on the compensation of inventors as they move from small startup firms to firms. When you show that their patent inputs to decline afterwards, but their compensation rises. Is there anything in the data that lets us distinguish they've become less productive inventors or their work has been pushed off somehow from they've become more managerial and they've taken on, for example, the role of managing a larger team of the bench work inventors, so that in some sense their comp has gone up because they in fact have a larger scope of command and control, but at the same time they're not doing as much of the patent work which they would have done before. That would seem to fit with the fact pattern, but it seems to have a different implication for how we think about what we learn about this for the innovation process.
Great. Thank you, Jim. We'll go next to Ignacio Visco. Ignacio, can you hear me?
Yes, thank you very much.
Yes.
Thank you, Ufuk. It was very interesting remark paper. You also had some ideas about the...
Thank you, Jim. We'll go next to Ignacio Visco. Ignacio, can you hear me?
Do you hear me? Yes.
Yes, we can hear you.
Thank you, Ufuk. It is a very interesting paper and presentation. You also mentioned the low rate of productivity in Italy in the last decades, and you try to connect that with some political issues, and that is certainly a relevant factor, but it is only statistically significant. I think it is less economically significant. The low rate of productivity in Italy depends on the dwarfism of industry, the small size of firms, and a substantial low level of knowledge. And the question is, since you mentioned large diffusion as a factor for the reduction in productivity growth in the States, my question is whether there is also a relation between the level of knowledge and the diffusion of knowledge. Clearly, the nature of knowledge needed by a society changes over time. It's not always the same kind of knowledge. And there may be a presumption that the level of knowledge has actually fallen in the last decade, and because it has also changed in the meanwhile. And this may explain the reduction in diffusion and therefore the reduction in the growth of productivity, as it may explain in a country like mine the low level of productivity associated with the low level of knowledge. And therefore a message would be to increase education, increase the investment in knowledge. I would like to know what you think about it. Thank you very much.
Great, thank you. We will try to get 3 more questions in, and I will ask folks if you could please be as succinct as possible so that we have time for that. So next up is Chad Syverson, and then we will go to Geeta Gopinath, and then Deborah Lucas. So Chad, your turn.
Sure, thank you very much. Actually, my question very much parallels what Jim Paterba